Hello traders, this is a quick video on how to do a stop loss, what it is, and where you kind of want to put your stop loss. So I'm just going to fire off a trade here, looking at the charts. If the market stays within this pricing range where it seems happy to trade, I would expect this market to perhaps not break out too much and come back within this pricing area. We've got a bit of movement up north. However, I'm hoping that will turn around. So I'm going to hit sell just for this example and show you what I would expect to do with a stop loss. So on the MT5 or MT4, you can click on the entry and simply drag your mouse up if it's a short position, and then that will create a stop loss. Now you can see here the negative profit will be about $2 or $1.80. And you've got the points there too, and you can actually drag that around to change where you want that stop loss. For a short position where you're selling the market, you expect the market to go down, and if you drag the pricing down, you can see that is a take profit rather than a stop loss. So you've got $2.55 there, and if the market comes down and touches that line, you'll make $2.55. If it comes up here and touches that line, you'll lose about $1.70. This one's on a 5-minute chart, and we don't have too much pricing history to judge where we want to put our stops or how far the market might move. I'm going to expand it out to a 1-hour chart, and we can see here we've got some pricing just here. So if I wanted to avoid any touches of this line, I could put my stop loss above that area. In saying this, you might have heard of liquidity pools. So everyone's probably looking at the same chart thinking, I'm going to put my stops just above this point and hopefully it won't break past this level. Now, false breakouts are a serious issue. What we can see here is we've got some wicks coming down, and then we've got this wick here which soaks up anybody that's holding a long position from all of this period here. So you've got people that are thinking, okay, I can get long and put my stops just below this line here. We can see here on this candle, the liquidity pool has been soaked up. All of those orders from the institution have been bought up so that the market can then go long. So on that bigger time frame, we can see that potentially we should have gone long. It's a very different landscape to the 5-minute chart. If, however, we do want to keep our short position, we may want to put our stops further away than the liquidity pool is likely to be. The other thing to look for is people don't seem to want to trade in this price area. There's a bit of activity here and a bit of activity here where the price doesn't sort of shoot off between areas of the market. Whereas this pricing section from about here to around here is no man's land. So if the market does break this level here, it's likely to at least make it up to around this pricing area. So again, you don't want to have your stops too close to where the market is likely to go. You want it unlikely to hit your stop, but likely to hit your target. When it comes to traditional risk-reward ratios, I'm not a big fan of that, simply because it's more about the probability of making money, getting the trades to hit your target without hitting your stop. Now, if your stop only gets hit once in a while, compared to your targets getting hit far more often, you've stacked the odds in your favor. So as for the risk reward that's commonly brought up in the trading community, I'm not overly convinced. This is also based off running huge amounts of tests and optimizations in the strategy tester using algorithmic trading. And the reason that I trust that is because it runs through thousands and thousands of trading scenarios and situations and trade conditions, and it spits out the final figure that you would expect based on a risk-reward ratio. And the 1 to 2, 1 to 3 doesn't always necessarily pan out all that well. As for where to place your stops, the obvious area is to place it just above the final highs or lows depending on what direction you're trading. However, the liquidity pools, as you can see by this candle here, they do soak up those liquidity pools where everybody else has their stops. If somebody wants to take the market in the other direction, they can essentially come down, soak up all of those trades, and take it back in the other direction. So being sure not to place your stop too close to your entry or too close to the likely trading area where the market is probably going to go. And the other thing is, if you're unable to back your decision and have a stop loss that is reasonable for the trade, then there's something potentially wrong with the trading psychology of the trader, where they're too scared to be able to sit through the trade, in which case the risk is likely to be too heavy, or there's more education needed to allow that trade to play out and see what actually happens. And that also comes down to, number one, experience, so seeing what actually happens in the market, but two, testing and seeing what actually happens if you do leave the stop where it is meant to be. If you enjoyed this video or took something positive from it, please hit the like button below. It lets me know this is helping others. To see more great content like this, please subscribe, hit the bell icon, and stay updated with the latest.